So the recording has started. Let's get down to business. Now, I need you to type this in just so I understand what you guys are doing, and that will dictate which direction I'm going to be going with this. For the most part, what are you trading? Are you trading indices? Are you trading stocks? What are you trading? Put it into the matchroom chat as I'm staring at that. Please don't use the Zoom chat because I'm not going to be able to see it. ES, equities, EF, looking at that, yeah. ES. Okay, so for the most part, you're all pretty much equities and indices. Is that a fair statement to make? For the most part, those that are here tonight, while Travis is typing, I'm going to ask you a very simple question. When you think volatility, what do you think? Pork bellies. Feeling good, Lois, huh? When you think volatility, what do you think?
Trust.
You trust you?
Tell us what you trust about so we can tell you.
Percent change is what you think of in terms of volatility. Okay, large price movements, large ranges. Don't be embarrassed. There's no wrong answer here. When you think volatility, what do you think? In a nutshell, movement. Volatility is movement. That's all. It's not a scary word. It's just movement. Percent change is not really movement. It's really just percent change from the close. I'm talking about what is volatility by definition means movement. That's all it means. When you think volatility as a trader, is it good or is it bad? I'm going to hit these points because I like where this is going. So let me start with Francis first. Uncertainty and risk. So there's nothing uncertain. Volatility just means the way something is moving. That's all it means. How does it get from point A to point B? That's it. That's all it means. Risk is a whole different ballgame. Uncertainty is, as a speculator, you're uncertain where things are going, but that has nothing to do with volatility. Volatility means, for example, let's say you're trading, pork bellies. We'll use pork bellies. Okay. You're trading pork bellies. Okay. If pork bellies moves on an average day, let's say 50 cents, hypothetically, right? Even though it doesn't exist anymore, but let's say it trades 50 cents, right? And then one day it's trading $2 in a range from high to low. You would say that its volatility has expanded. It's normally trading 50 cents. Now it's trading $2. So it's trading 4 times its normal volatility, its normal movement characteristics. Okay. That's all volatility means. Okay. It's nothing to be afraid of. As a trader, volatility is your best friend. As an investor, it's your worst nightmare. As a trader, you need volatility because that's how you make money. If you get into something and it's not moving, you're wasting your time. What are you doing there? As a trader, your time is limited. You need things to be moving. Otherwise, you're not going to make any money. As an investor, you don't want to see things having a lot of volatility. Why? Because investments are supposed to be slow and steady. Trading is supposed to be fast. Not, I'm in and out of the trade in 5 seconds, but it needs to be moving. If it's not moving, there's no reason for you to be there. You understand the difference? So far, we cool on this?
Don't look at me like that. I'm not looking at your organization.
So we're in some interesting times right now. So before we get into other aspects, I want to address something that you all need to be aware of, and you need to be aware of it effective immediately. This is not, let's worry about this in 2 weeks from now. This is tomorrow morning. You got to be aware of this. Going to bed, you got to think about this moving forward. Okay. What I like to do, these things, I like to give you some things to think about. But I want to give you practical also. I want you to use this stuff instantaneously because otherwise you get bored. I get bored. We all get bored. If I give you something you can't use for another 3 weeks, it's pointless and stupid, right? Would you agree with that statement? You want something you can use instantaneously, right? Don't be uncomfortable. I don't know any of you. I'm already comfortable with all of you. So don't be afraid. Okay. Who knows what's going on in the world right now? Who is not living under a rock and knows what's going on in the world? Just 2-word answers. I don't need more than that. I don't need a whole dissertation. 2-word answers. What is going on in the world right now? A lot. Trade war, good. A little uncertainty, good. I live in Iraq. That's fine. Sometimes that's good too. Michael, do me a favor. Go in, use the mansion link for what's it called, for typing. Steve wants everything. Steve asked that everything should go on the mansion. Okay. But cluster, he's definitely on target. He's definitely not on target. He's definitely not wrong. You have a lot of what I would call tape bomb exposure. That's really what you have. What does that mean? Algorithms, for the most part, are not there to hurt you. They really are. They're not out to get you. They're not out to stop hunt you. That's not what they're there for. Algorithms are designed realistically for a few things. One of the things that they do is that because they can move very quickly, a lot of the firms, not all of them, but a lot of them, who here trades equities through, I'm going to take a step back for a second. Who here trades equities not through a regular broker, but has direct access, where they're putting their orders on an ECN, whether it be ARCA, NYSE, Nasdaq, BATS? Who has that? Anybody have that ability? Does anybody think I'm speaking Japanese? Oh, come on, I was supposed to make you smile. Come on, guys. A little smile. Give me something. Okay, what direct access means, while you guys will give it a second. Okay. Yeah, but you're not having that. Okay. If you're on Lightspeed, you have it. If you're on any other of these brokers, you don't have it. Basically, what that means, very simple, what direct access means, when you place your orders, and I'm going to
Because I don't
specifically
know.
talk to people who are trading stocks, equities. When you have direct access, it means that you're putting your orders directly on an ECN. An ECN stands for it's an electronic network. So there's ARCA, there's BATS, there's EDGA, there's EDGX, there's the NYSE, there's the Nasdaq. Each one of these is piping to the market. That's basically what it is. Just think of it, if you're a plumber and you need to get water from point A to point B, that's what it is. The ECNs are the pipes. That's really all it is. Okay. However, when you put your orders on an ECN as a limit order, and this only works for limits only, if you get filled, then the exchange says, thank you very much. We appreciate you providing liquidity because you put out a limit order. We're going to give you a rebate. Okay. Usually, if I'm not mistaken, I don't really check this that often, but you figure per 100 shares, it's not much. Talk about like 20 cents, 30 cents. You're not really talking about a lot of money. What it does is it allows some of the cost to be offset. Okay. Because when you're trading in the live markets, you have costs. You have exchange fees, you have clearing fees if you're in the futures, you have reg fees. There's all kinds of fees that are not negotiable. Okay. And then you have commissions, obviously. Exchange fees are negotiable if you're big enough. So a lot of these high frequency firms what's doing is they're providing liquidity. So they're not only trading between the spread. What they're doing is they're trying to capture also liquidity rebates. Now you're going to think, what's 30 cents? Who cares? If you're doing this thousands and thousands of times over and over again on an average day, it adds up. Over a week, it adds up. Over a month, it adds up. It adds up, right? Obviously, they're not paying commissions. And they pay, because of their volume, the sheer volume, their cost structure is basically next to nothing. So if their cost structure is next to nothing and they're grabbing these liquidity rebates, you can imagine how much money we're talking about. Makes sense? Yes, no, maybe so? I want to keep you engaged. Okay. Fine. Perfect. This only works in equities. In the futures markets, liquidity rebates do not exist because it's basically, to a large extent, it's almost a monopoly, because if you want to trade ES, there's only one place you can do it. You got to go to CME. If you want to trade, let's say, orange juice, there's only one place you can go. You have to go to ICE. So it's very monopolistic in that regard. So there's no liquidity rebates. Okay. It just doesn't exist. Okay. So that's step number one. Okay. So there are some algos that are just basically trading in back and forth just to capture these rebates. That's really what they're doing. There are other algos that are time-based algos. Those algos turn on at specific hours of the day. 9 o'clock in the morning, 9:30 at the open. Some start at 10 o'clock at night in the morning. There's certain algos that turn on at about 11:30 Eastern time. Everything I'm talking about is Eastern. But at night, some turn on about 9:30 at night. It's just the different algos that turn on at different hours in the day. Then you have what I like to call the predatory algos. These are the ones that are designed to attack headlines with sheer force, up or down. So you usually see these algos on news headlines. So for example, for those of you that did not know, about 20 minutes ago, 30 minutes ago, there was an announcement that basically the US is stopping military aid to Ukraine. Okay. There's a way that they're doing it. It's not necessarily for aid that's on its way or military aid that's already in Europe on its way. It's new aid is being temporarily paused. If that came out between 9:30 and 4 o'clock, all hell would break loose, right? Would you agree with that or disagree with that? Okay, good. Good. That's what I like to see. Good. So it's happening at night. So the market's nothing's really adjusting to it because it's low liquidity. So it'll be dealt with. Don't worry, it's going to be dealt with. It'll be dealt with later tonight and tomorrow morning. When Europe opens, the DAX will deal with that. And then tomorrow morning, we're going to deal with it. Trust me, we're going to deal with it. Your biggest problem that you need to worry about right now are tape bombs like that. That's your biggest hurdle right now, nothing else. Because these are things you can't control. One of my specialties, my personal specialties is energy. So we were in energy, my group, we were in energy today. And it ended up being that it was basically slow and it was doing nothing. And then I would like to call a tape bomb came out that basically OPEC is going to be continuing with the cuts. And then all of a sudden, literally energy just fell out of bed, literally just instantly just fell out of bed, and it fell out of bed very quickly. Okay. I wasn't in it already. I was already done for the day. I had one thing left. My guys they capitalized on it, but it was quick because it was just a tape bomb. That's not something you can foresee. You cannot foresee OPEC making this announcement at 12:30. Hey, by the way, we're doing this, or the administration getting up and saying, okay, we're lifting Russian sanctions, or we're pausing aid to Ukraine, or whatever. Okay. However, you do need to be aware in markets where there is heightened volatility, like we find ourselves today and currently, that things of this nature can happen. Okay. So before we get into that, there's certain things you need to be aware of, and you need to be cognizant of it. And it's hard because there's a lot of FOMO that gets involved, but you have no choice. Okay. Bounces in downtrending markets like we're finding ourselves right now. Bounces are violent and vicious, and they are not going to stop. So when you get some kind of crazy rip like we had on Friday, for example, it was very violent and it was very vicious. Anyone see it? Anyone see it happen? Everyone see that move when it happened after the press conference? Was anyone trading Friday that they saw this? It was very violent and vicious, right? It wasn't a joke. If you were caught on the wrong side, you didn't just get your clock cleaned. You got your neighbor's clock cleaned, and your brother and your sister's not clock cleaned. You got killed if you were on the wrong side, right? So these are things you need to be aware of. Now, with that being said, that doesn't mean, again, I'm going to repeat this, that doesn't mean that every down move is something you should be selling and every up move is something you should be buying. Okay. You got to use your head. This is not just a game of art. Of science. It's a game of art. You really have to use your head. Okay. And what I mean by that is, if you see a market is going down intraday, I'm going to give you a secret. Okay. I don't know how big you guys trade. I'm going to assume that most of you are smaller traders. And this is not insulting. Are any of you are more on the smaller side, MES, micros, not really trading huge position sizes in regular size contracts? And that's okay. There's nothing wrong with it. 100 lot, 100 share traders, 200 share traders, 300 share traders at most. Be honest, guys. Come on. Don't be embarrassed. There's nothing. We're all here together. Okay. It's very important for you guys to realize this, and I want you to really understand this, okay? Because you think at times, because it's the psychology, that when something's going against you, that they're out to get you. How many of you have thought this? When something's not really working, they got me. They're out to get me. They're looking to get me. They want to take my stop. They want to get me. How many times have you thought that? Not necessarily today, but in general. How many times have you thought that? Oh, they got me. They're looking to get me. They took me in my position. Doesn't make a difference. Evals, no. Doesn't matter. Let me tell you a little secret. Okay? I'm going to tell you a little secret. And I don't mean this to insult you. Okay? Nobody cares about your positions. You are not big enough for anyone to care about you. a 1-2, a 10 lot micro, which is a 2 lot, which is basically a 1 lot regular size contract, nobody cares about you. Honestly, we're all friends. We all care about each other in this group. But in reality, from the market perspective, you're a small fry. Nobody cares about you. Nobody. Okay. As a matter of fact, I'm going to go a different way, and I'm going to tell you something. I talk about this with my group, and I'm going to bring this. I'm going to ask you a question. Okay. If you were $1 billion fund manager, pizza, don't say anything. If you were a $1 billion fund manager, I think some of you may have heard this example before, and you need to hedge off $1 billion, how many ES contracts would it take you to do it? And how easy is it to do it without moving the market? Not MES, ES. How many would it take you to do it? How easy is it to do it? And would you move the market by hedging off $1 billion of stock? And for those of you that need to know what the math is, let me know and I'll tell it to you right now so you can figure it out. A couple of thousand contracts. No? Like a ton. It'll probably take a week or two. I know you do. Don't say it. Troublemaker. Okay, so I'm going to tell you like this. It's very simple. Let's first figure out how to do it. How do you figure it out? Okay. So we'll take the regular size contract, right? So every point it's $1. It's $50, right? 4 ticks, $50, correct? Incorrect? Who disagrees with that statement? One ES contract for a point move is equal to $50. Anyone disagree with that? Okay. So let's figure out what the notional value is. Okay. Take $50, times it by the current price of the ES. So let's just say the ES right now is, let's just see, it is 58.70, right? Do 58.70 times $50. Okay. That is the number, the dollar amount or the dollar value of stock in the S&P that you would hold. Divide $1 billion by that. And that's how you get 293. Divide that, let's just say, by $1 billion. That's how many ES contracts you need in order to be fully hedged dollar for dollar. Now, in terms of the ease, I think it was Phil who said it will probably take a week or two. Phil, what if I told you could do it in a couple of minutes and you probably maybe you move the market a point, maybe, to do 3,300 contracts? Easy. If you think about the volume on an average day, what's the volume in the ES, not the micro, on the regular ES contract? What is the volume on an average day? 1.2, yeah, 1.2, 1.5, right? Around there. So it's really liquid, right? So and if you look at the order book, which I'm hoping that none of you do, but if you do, you look at the order book is very thick. There's a lot of liquidity. So if you want to move 3,700 contracts in blocks of 500, you could easily do it just by shooting it out to the market, and the market would absorb you. Maybe you move the market a handle, maybe. And then you're fully hedged. Okay. With me so far? Yeah, exactly. So you have algos that are designed also to hedge off portfolios. That's what also they're doing. Okay. So one of the reasons why you get these outsized crazy moves at times is because when liquidity dries up and someone has to put in a hedge, let's say of 5,000 contracts, let's just say, and the liquidity dries up, you're going to get these moves until all that order is filled, right? Does that make sense to you so far? If I'm trying to put on an order to sell or to buy at, let's say I want to sell 3,000 contracts, but there's only 4 available at price at 5,800, and the rest of it's available at 5,600, 100 handles away. What do you think the market's going to do with that order? What's going to happen? There's only 4 available, and then the next price that was 100 is 100 handles away. Market's going to collapse until it gets that order filled, right? Does anyone disagree with that? So a lot of the times, the algo, to a certain extent, is not necessarily looking to hurt you. Really, for the most part, they cannibalize each other. That's really what they're doing, to a certain extent. Okay. Now, how does that affect where we are today? With electronic trading, where most of your orders are being done through algorithms for the most part, not the point-and-click trader, but for the most funds are using algos. When some kind of crazy headline hits the tape, you know what happens to the algo? You know what the algo does? Does anyone know? Anyone want to take a guess? You see it all the time in big data moves. What happens? My guys, you're sitting trading this stuff. You don't know what goes on? It doesn't make any difference. Selling, buying, it doesn't matter. When news events hit the tape, what happens? What does the market do? Up or down? What does it do? Gets really thin. Book gets thin. Volatility goes up. Why? Because the algo right away, what does the algo do? What does it do? Not liquidity hunts. What does the algo do right away? You know what it does? It pulls the offers. It pulls its bids immediately. Why? Because when they don't know what's coming, they automatically come out of the market. So I'll give you an example. Okay. You can do this on Friday. Okay. All of you do this on Friday. Okay. Because Friday is going to be a good day to do this. Friday is NFP. Okay. Non-farm payroll comes out at 8:30 in the morning. Okay. Here's what I want you to all to do. You're going to see this with your own eyes. Okay. At 8:28, actually 8:25, do it at 8:25, because it gives you a few minutes to get used to what's going on over there. Pull up a DOM. I want you to look at the order book. I want you to look at the order book at 8:25 and then look at the order book at 8:29 right before the numbers come out. You're going to see how all of a sudden on both sides, the order books basically dry up. All of it, the bids get pulled, the offers get pulled, everything gets pulled almost instantaneously. You see it happening. So if you have, let's just say 500 on each side, it drops down to 50. You're going to see it with your own eyes. As soon as the news hits, it's going to be quick. So you're not going to really see it. But a couple of seconds later, when the market stabilizes, you're going to see that the books got thick again because the algos came back. Okay. The order book came back. Okay. So when news, like for example, this Ukraine news that came out about an hour ago, were to hit the tape, it's very much the mindset of shoot first, ask questions later. Okay. So they're going to pull everything and you're going to get these crazy outsized moves. Okay. That would be put into the bucket of bad volatility. Okay. That is volatility that you cannot control. Your job is not to sit and try and capture every single move. I want to repeat that. Your job is not to sit and gamble 3 seconds before any type of news event comes out and maybe you hit the lotto and then the market goes ripping in your direction. That's not your job. Your job, plain and simple, and I'm going to speak freely because we're all adults here, is to protect your ass at all costs. At all costs, you need to protect your ass, no matter what. If it means you sit on the sidelines and you wait, so be it. Why? When you get instruments that are, I want to use the word expensive, but in relative terms, get higher up there in price, they are going to move. A 1% move in a $50 instrument and a 1% move in a $21,000 instrument is still 1%. 1% in a $50 instrument is going to be how much? Who wants to take a guess on that? What's 1% of $50? That's 10%.
50 cents.
50 cents. And on 21,000, what's 1%?
2.
So it's still the same 1%, but the volatility of a $50 instrument is 1% is 50 cents. So it's not really moving around that much. Whereas the volatility of a $21,000 instrument, a 1% move is 210. You understand the difference? Anyone not understand the difference? Okay, good. Like this. Fine. Okay. Any questions so far? Hey, even better. Okay. So I'm going to ask you a different question. When you're going about your day, how do you judge volatility? What do you look at? Do you look at the VIX? What do you look at? Type it. What are you looking at? Price action of what? Fast price is moving. That's just speed and pace. That's not really volatility. That's more pace of the tape. It's not really, I wouldn't say it's volatility. It's a form of volatility, but it's not really volatility. Meaning you could be going fast and sitting in the 30-cent ranges, be moving back and forth like a flea on crack and be going nowhere. And you could be moving really slow and be moving in $4 ranges. You don't look at anything. Okay. So how do you judge? Do you have any way of looking at volatility? You just ignore it completely. How fast it takes price to move at a certain range. Okay. Are you looking at expansion of that range? Travis, those are stocks. Those aren't really volatility. That's really just stocks. You could use the VIX. Who knows what the VIX is? Who's heard of the VIX? What else you could use besides the VIX? We'll get to the VIX in a second. Has anyone, for the most part, the ones that are trading indices, are you doing S&P or are you doing tech? What are you doing? Are you doing Nasdaq? Which one are you doing? Give me 1 second. I'll wait while you're typing. Give me 1 second. Okay, good. Does anyone here trade Nasdaq? Did anyone trade the NQ or the MNQ? I know Taco's here, so he's gonna. Don't be embarrassed. He's not gonna yell at you. Who here is trading the NQs or the micro NQs? If anybody, you do. Okay. When do you trade it, Mike? When do you find yourself trading it? Are you trading it at the open? When are you trading it? Open is not good. So how long do you wait? So you're not trading it from 9:30 to 4. So you're saying when the stock market's open, you're not in it, correct? Okay. So he brings up a very good point. Okay. Has anyone ever traded Nasdaq, or has anyone looked at the Nasdaq at 9:30, and specifically the Nasdaq? You want to know why? Should I tell you why? And it's not because of what you think. You want to know why? That's bad volatility. For option hedging, it's not even the initial balance. It's actually not even that. It's a good guess, but it's not even that. You know why? But the option hedging, you're doing that for the Nasdaq at the open? Is that when you're doing it, or are you just saying option hedging? While he types, I'm looking at the screen while he types. I'm gonna tell you like this. The Nasdaq is the perfect example at 9:30 of bad volatility. I'm gonna tell you why. And for those of you that have heard me beforehand, this might be a little redundant, but for those of you that haven't, it's going to be fresh for you. So for those of you that heard it beforehand, too bad, because it's my webinar. Haha. No, I'm kidding. I'm kidding. The reality is that by nature, what is an index? An index is a basket of stocks. It's a basket of something. That's what an index is, correct? So if you went to a bakery, you did a basket of cookies, and you had a cookie index, right? The underlying would be the cookies, right? Correct? No, it's not even that. It's not even that. I'm going to get to it. Okay. So what happens in electronic markets? You have a situation where even though the markets are opening up, they're opening up the stocks at 9:30 electronically, and it's very efficient. At the same token, while this is all going on, because the order books have not been fattened up, so to speak, you get a lot of huge spreads at the open, whether it be in Amazon, Microsoft, Apple, Google, Meta, Tesla, whatever. The spread, even by the way, Johnson & Johnson, McDonald's, even those names as well. At 9:30, the books have not been fully open yet, even though it's electronic trading. So what ends up happening is that because these spreads on these stocks are very wide, you know what happens? You get orders printing all over the place. So you're getting orders, you get what's called market on open orders. And these orders are basically slamming left and center. And you'll get orders printing all over the place. They'll hit the bid, they'll take the offer, they'll trade, the orders will go in the middle of the spread, they'll go out of the spread. It's all over the place in the first couple of seconds. So what do you think the index is doing? If the index is a basket of underlying names, right? And all of these names have not fully opened and they're all printing all over the place. The index itself, you know what it's trying to do? It's trying to keep up. That's all it's trying to do. So because of this reason, you get these names, it's like drinking from a fire hose, exactly. Well, the index itself is literally just trying to keep up with all of these stocks that are printing all over the place. You'll notice that after a couple of minutes, usually it's within 5-10 minutes, the Nasdaq comes down. It's at 9:30 and at 9:40, it's a completely different instrument. Forget about the fact that it's moving fast. Leave that alone a minute. But in terms of the way that it's moving, the complexion completely changes because now all the stocks are basically opened up and now the index can just go about doing its normal thing of calculating. Okay. So the 9:30 is what I would call the worst volatility you could possibly imagine because the index itself doesn't even know what it's doing yet. It's literally just trying to catch up with everything as all these stocks are printing. Okay. Does that make sense to any of you, or is that like completely foreign? If it's not, I'll explain. I'll go more in depth. I just want you to understand the different types of volatility that are out there. Okay, for those of you that are trading this, the S&P doesn't have it as much as the Nasdaq. You want to know why the S&P doesn't have it? Anyone want to take a guess? Legit question. More volume? That's one thing. Yeah, that's one thing. But let me ask you a question. Okay, it's a good answer he's giving. The NQ, what index is it actually tied to? Is it tied to the Nasdaq composite or is it tied to the NDX? Which one is it? Which one is it tied to? NDX. NDX. Weighted average of company composition. Yeah, but which cash market is it tied to? Is it tied to the Nasdaq composite, the comp, or is it to the NDX? Which one is it actually? What's it actually tied to? We all know the S&P is tied to the SPY, right? It's easy. It's an easy one. S&P, you're trading ES, it's S&P. It's easy. What is the net? What is the NQ tied to? Qs, exactly. It's tied to the NDX, right? It's 100 names. 100 names versus 500. Here's another thing I'm going to ask you, because you're all looking at this, so get a little bit of understanding of what you're actually looking at, okay? Do you know that the top 11 names of the Qs or the NQ is basically the top 10 names is the exact same top 10 names in the S&P? Do you know that they're the exact same? Did you know that? Literally, stock for stock, they're the exact same top 10 names. Do you know that? We'll get to that in a second. Here's the difference. The difference is the top 11 names of the NQ or the Qs. Do you know what that percentage weighting is of the NQ 10, those 11 names? You want to know what it is? How much power those 11 names have over the index? Who wants to take a guess? Who else wants to take a guess? Only 2 people want to take a shot at this? You win a prize. So the actual number for the NQ is 51%. 11 names make up 51% by weight of the NQ. Do you know what the top 11 names make up of the S&P? You want to know what it is? What's the weight? Top 11 names. Who wants to take a guess? 32%. Those top 11 names. Same overlap. One is 51%. One is 31%. Okay. Also, one's 500 names versus one is 100 names. More importantly, for those of you that don't know this, do you know that the MNQ does 3 to 4 times the average volume, the average daily volume than the NQ contract itself? The micro does about 3 to 4 times the amount of volume than the regular NQ contract. So if the NQ, let's just say, does 200,000 shares, just making up a number, the micro does 800,000 consistently every day. Every day, the micro does more volume. That does not exist in the ES. In the ES, the regular ES does more volume. Okay. So I'm just giving you a little bit of context of how this going to affect your volatility. Very simple. If something is very thick and has a lot of volume in it, right? Is it going to be hard to move it? Or is it going to be easy to move it? It's going to be hard. Very good. So that's why you can push the Nasdaq around a lot easier than you can push the S&P around. What's harder than the S&P to push around? Does anyone want to take a guess? And it sometimes can have a lot of volatility, but the liquidity itself keeps it very. Who wants to take a guess? What can be pushed? What's harder than the S&P? Nope, it's not the YM. It's a good guess though, but it's not an indice. Which one? That's easy. Which one? There you go. The 10-year. The 10-year is the thickest instrument on the planet. It is the hardest thing in the world to move. It's the ZN. Okay. Now, you can have a lot of liquidity, but you can have issues with volatility. Okay. So now we've identified what's good. We've identified so far what's bad volatility, right? Would you agree with that statement? We've now started to figure out what is considered bad volatility. Yeah. 100%. I want to make sure that you're cool before we move on. You're understanding what is bad volatility. Nasdaq NQs at 930 is bad volatility. So you know what you do in that, and when you see bad volatility, you know what you do? Don't be there. Don't be there. Don't be in a rush. Don't be there. Okay? Take a shower. Take a cold one if you have to, but don't be there. Okay. So how do I assess volatility? Very simple thing. Simple for me because I've been doing it for so long, but it'll be simple for you too. Okay. Conceptually. Is anyone familiar with a concept called the straddle? Everyone know what a straddle is? Volatility is the way something moves. It's just another way of defining movement. That's it. That's all it is. A straddle is basically, it basically is a delta neutral strategy. That's really what it is. So what a straddle basically means is that you're buying a put and a call at the same time, and you make money on the premium if the premiums get above the strike. That's really what it is. It's a way to figure out, because it's delta neutral, the premium basically tells you what is the expected volatility, because the premium is the volatility. What do I mean by that? So let's assume, I'm going to share in 1 second. Okay. Let's assume, let me just get here. Hold on. Let me pull it up. I'm going to start sharing. Who wants to share? Sharing is caring. Who wants to see sharing? Who's excited to see some sharing? That's one of my guys, by the way. I'm going to beat him up later. Let me get this up. Okay. Naked, yeah. You're basically buying. It's a directional buy. It's basically directional. When you're doing it, you're doing it based off of direction against the premium. Sharing going on over here. Okay. This is going to change tomorrow morning. Okay. This is going to change tomorrow morning. I'm hoping. I've been having these issues with this thing. Do you guys see the name box? Do you see that in the screen? Do you guys see it? Like the list of names over here on the right side. Do you see it?
Oh.
I'm having that issue where what's it called?
It's usually in the recording only, but not when you do it online.
Okay, so let me minimize this. I tried this the last time and hide the thumbnail thing worked. So let's see if that works again. Okay, fine. So these are Wednesday straddle, okay, for the ES. So I'll explain to you what this means, okay? Right now, the ES is currently trading 58.68. You see that? 58.68? Oops. No, does anyone see that? Does everybody see the 58.68 here? It's important. I want to make sure you all see it. Okay, good. Okay. Forget about this. Forget about this. Forget about this. You see here where it says last X? See that? Everybody see it? Okay. We're going to concentrate here. Okay. I'm going to tell you what this is telling you. Okay. Now, granted, it is 8 fit. By the way, is everybody here in the US? Or are you on the East Coast? Someone on the East Coast? So this is all subject to change because it is now, let's round, it's 10 to 9 on the East Coast. So let's keep things in context. Okay. What this is telling you is if the market right now is trading 58.66, so we'll go here to 58.65. Okay. You see the strike over here? See this? What I just highlighted? Everybody see it? Okay, good. If we scroll over at 58.65, okay, what this is telling you that the expected volatility, meaning the expected movement of the S&P is $85. That is the expectation. So at 9 o'clock, when I'm looking at this, I'm trying to figure out what's going on. I say, okay, the S&P is trading 58.67. Premiums right now are 85. That means they're expecting this sucker to move around about $85 from high to low. That's what they're expecting. That would be a lot of, would you say that 85 handles a lot of movement in the S&P and the ES? Quick answer, yes or no? Is 85 handles a lot of movement during the day, on an average day for the S&P? That means if you were trading SPY, that's $8.50. Now, I'm not talking about later. I'm talking about in general. In general, would you say that's a lot of movement? Yes, it's more than 1%. Yes. Yes. Okay, good. What this is telling you is that your expectation should be heightened volatility. If we're trading closer to 58.70, the strike now is the premium is about $83. Okay. Which means that the SPY would basically be moving about $8. So what does that tell you? That tells you that volatility is, who wants to finish the sentence? If it's normally trading $2 to $5 and now it's going to be trading $8, what does that tell you? Exactly. Heightened volatility. What does volatility mean to you as a trader? No matter how you trade, I don't care what you do. I don't care what you're doing to trade. I want to know, what does that mean to you, volatility? You better believe it, baby. That's what it means. That doesn't mean success. That's not what it means. It means opportunity. We're going to get to size in a minute. It means opportunity. As a trader, Write this down, tape it to your screen. I don't care where you put it. Volatility is your best friend as a trader. As an investor, it's your worst nightmare. As a trader, you need volatility. Otherwise, you're not going to make any money. You need things to be moving around. Otherwise, guess what happens? You might as well just twiddle your thumbs because you're not going to make any money. You understand? You with me? I don't want to hear crickets. I want to keep you all engaged. Yeah, it's Globex. So you can't use Globex because it's going to change by 9 o'clock. Come 9 o'clock tomorrow morning, it's going to be different. So I'm just giving this for illustration. It's literally just illustration. Okay. Things are subject to change in Globex. So you gotta take things with a little grain of salt. This is just for illustration purposes. If this was during the day, these numbers would be flying all over the place. Okay. So you got to cut me a little slack. Okay. Okay. This is one way that I'm able to judge volatility, because if I know what to expect, then I can start to plan out my day. How are things going to move? Okay. That's one way I do it. Okay. Again, volatility is not bad. Okay. Volatility is opportunity. That's all it is. I will tell you, but this is me. I don't want any of you to do this because you're not me. And for you to do what I do would be insane. Okay. It doesn't work. In the most volatile environments, I'm at my biggest. That's me. Because my methodology, it lends itself to that. Okay. The way that I trade lends itself to this. Okay. I don't do as well in slow, grindy, range-bound markets with low volatility. I get stopped out a lot, personally. Okay. But that's the way I do things. Okay. So when markets are at their craziest is when I'm at my best. That's usually when I'm doing my best. Okay. But again, that's me. Okay. That's fine. Listen, to each his own. You do what you're comfortable with. I'm not here to give you a lesson on how to trade. That's not the purpose of this discussion. The purpose of this discussion is for you guys not to be afraid of volatility. It's your buddy. That's really what it is. Volatility is your buddy. By the way, in highly volatile markets, they're more forgiving than when things are slow. So if you make mistakes in very volatile markets, you have a better chance of correcting those mistakes depending on however you trade and getting your money back and then some in very volatile markets that are not moving as fast and are not really moving around. If you get stopped out, you're basically to a large extent shit out of luck. When something's moving around, it gives you more opportunities to refocus, retool, and figure out a path forward. Just so you should know that, by the way. Okay. But again, I'm not here to ram that down your throat. I'm really more discussing with you volatility, how you should do it, when you should be looking at it, when is it your friend, when is it not your friend, and et cetera, et cetera. Okay. We cool so far? If you want to do other things, it's a whole different ballgame. It's a whole different discussion. It's not for tonight. Okay. Now, this is step one. Now, let's look at something else. Okay. Let's look at this. These are what we call the VIX futures. VIX futures. Who knows what the VIX is?
Volatility index.
Besides for him, who else knows what the VIX is? Bunch of cheaters. I'm kidding. Okay.
It measures if the market is over capacity
The VIX future.
or if it's under.
What do you mean by that? Overcapacity. What do you mean by that? Overextended? Okay. You want to expand upon?
Maybe I look at it as maybe there's a lot of people who is selling.
Okay. Let me expand upon it. Is that okay? Is that cool?
That's fine. I'm here to learn.
So let me expand it. She's not wrong. Happens to be she's not wrong. And if you look at what's being written, they're not wrong. Okay. What the VIX is, in reality, it's a mathematical equation. It's measuring the difference between puts and calls. When you see a VIX that's elevated, it means that they call it the fear index. It means that there are people who are trying to protect. because because again, what I told you literally a minute ago, the group, volatility is a trader's best friend. Volatility is an investor's worst nightmare. So if you're a portfolio manager, then when the VIX starts to get higher, you start to get a lot of volatility. It wreaks havoc on your positions. So how do you protect yourself? You could buy puts, right? You could sell futures. You could do whatever you have to do to protect your investment portfolio. Okay. So when volatility is very cheap, whether you buy the VXX, the UVXY, whatever you're buying, and you could use it as an insurance policy. Okay. The VIX basically tells you your insurance is expensive or your insurance is cheap in the most simplest of fashion. Okay. We cool so far? Well, let me show you something. Open this up a second. Okay. Let me show you something. Okay. This is today's VIX, cash VIX. Today's cash VIX closed at $22.78. Okay. That's where it closed. Okay. However, these are the VIX futures. Anyone notice a difference between the two of them? Cash VIX is at $22.78. Look at where the VIX futures are. Okay. Anyone want to tell me what they see? What are they noticing? Take a second. Hold on 1 second. Sorry. What the VIX futures are telling you is the following. Let me go a different way. A second. You know what? Let me go differently. Let's ask a logical question. Okay. If you see the cash VIX is at $22, what do you think the VIX futures should be doing if volatility is expanding and we're getting these 100 handle moves intraday? What would you expect they would be thinking about what's going to happen in the future? And they meaning market participants. Before you answer, take a deep breath, think for a second. Okay. The market is moving around and flying all over the place, up, down, sideways. It's literally rocking and rolling every single day, all over the place. The cash VIX has been slowly creeping up. It's now trading at $22.78. Okay. What do you think, if you were a market participant, of what you think if things continue like this, where is the VIX going to be? He said up. Anyone agree or disagree with that comment? It should be higher. Okay, that's one person. Don't be shy. I'm going to make it in a grid so I can see you. Don't be shy. You would think that because it's a future price, you would think the VIX futures would be higher, right? That's what you would think. If the market is going, for lack of a better term, buck wild every day, up, down, 100 handles, 50 handles, 30 handles, every day it's just going, exploding all over the place. You would expect by looking out at the VIX futures that these numbers would be higher. So if cash is at 22, you would expect this to be at 25, 27, 28, 26, kind of hovering around there. Because they would expect that the market would be getting a little bit crazier. Volatility is going to pick up. What? How do I protect myself? I'd buy volatility so that I can protect myself. Has anyone heard this concept before? Waiting for some of the type. Oh, okay. So that's really what's going on. Okay. So the VIX goes higher when the SPY goes lower. Yes and no. For the most part, yes, you're correct. The relationship is when the SPY is going lower, but it depends on how it goes lower. If it's going lower like it did today, then yes, the VIX should be going up. Okay. Yes. However, you can have situations where the S&P is going up, where the SPY is going up, and the VIX is also going up. Okay. Because what in essence is the VIX? It's protection. You're buying volatility, right? So by buying volatility, what you're doing is you're finding a way to protect yourself from the market's downside. Okay. Because usually volatility picks up when markets go down, right? Who's heard the concept? Escalator up, elevator shaft down. Who's heard that concept, that what's it called before? That saying. Okay. Yeah. Good. Perfect. Okay. So what they'll do is they'll buy certain things. Either they'll buy futures, VIX futures. They'll buy the VXX, the UVXY. You've heard of these VIX products, these VIX ETFs. Has anyone not heard of them? Okay, good. Very good. Okay. No, it's not. No, these are ETFs. They trade on the New York Stock Exchange. They trade on the Amex. Yeah, they're ETFs. Just like a SPY, the Q, the GLD, the OIH, the XLE, same thing. It's an ETF of volatility. That's all it is. Okay. So what the VIX is telling you, or the VIX futures are telling you, is that they don't believe that the market is that the volatility is going to stay elevated. It's trading underneath cash. They think volatility is going to come in. They being market participants. Okay. That's what it means. What it also means, by the way, is that their hedges aren't working. Huh? What? That's what it means. Because when you have the VIX futures underneath like this, underneath where the cash is, and it's not really moving forward, it means, let me just pull this up a second. Hold on. Let me move this out of the way. One quick second. Let's get this down here. Everybody see the charts I just pulled up? I want to make sure you see it. Everybody see the charts
Yeah.
clearly?
Crystal.
Okay. This is the S&P cash. Whoops. Whoa, that's a little too big. Okay. Let me ask you a question. Simple question. Okay. It's going to be literally kindergarten 101. Okay. When the market's up here, the market starts to pull back, right? Like it was doing over here, right? This is the cash market. This is not the ES. This is the S&P. This is the S&P 500, the actual cash index. Okay. Not the futures. What would you think people would be doing if they've been buying up the entire time? And don't say the word sell. What would you think people would be doing when the markets had this big move? And now, let's say from here, the markets had this move and it's moving up and now the market starts to roll over. What would people want to do to their positions? And don't say the word sell. Hedge. Buy puts. Exactly. Hedging. Same concept, right? Here's the problem. And this is what the VIX futures are telling you. Okay. The problem that you have is because the VIX futures are inverted to the cash market, because again, the cash is trading at 2278, right? 2278. And the futures right now, I know it's after hours, so it's a little bit more different. I get it. I'm just using this for illustrative purposes only. Okay. They're underwater on their hedges because volatility is moving up, but their hedges aren't working. They're not making any money. So as the market's pulling in, right? As the market's pulling in, let's get this up. Sorry. Their hedges aren't really working. Pretty crazy, huh? Pretty nutty, huh? Yeah, I'll get to in a second. Hold on. That's not a bad idea. Okay. So let me ask you a different question in a minute. Okay. This is going to be a little bit more my personal feeling. Can anyone really give an answer as to why we ripped to the upside on Friday into the close? Anyone want to take a gander on that, on why that happened? And it wasn't technical. It was not technical. Nope. Good guess, but nope. Cobb, you're halfway there. The Jeff and Speeder are there, but expand upon it. What does that mean? Nope. Not even close. Good guess, but not even close. Expand upon this month-end thing. Nope. Not cash settlement. Nope. Not taking profits. Nope. Nope. You have good answers, but you're not getting. You're not there. You're not going to believe it when I tell you. Tell me when you're ready to hear the answer. I'll give you a minute. It's a good exercise. If it's short. Not rebalancing. Nope. When I tell it to you, you're going to understand the way the game works and why today happened the way it happened also. We'll get to that in a second. Who wants to hear the answer? Tell me when you're ready. Anyone want to take one last shot before I give it to you? Nope. It's not liquidity sweep. Nope. How about if I give you the words? You ready? Monthly statement blow up. If you're a fund manager or a 401k manager or a pension fund, okay, you have to send out monthly and quarterly statements, right? Does anyone get that in their 401ks or their investment portfolios? You get like monthly, really it's quarterly, but you get like these statements, right? You probably usually throw them in the garbage or throw them in the shredder. They need to get the mark. So what they need to do is that when the market was getting basically ground into the oblivion for most of the month, because we got creep, they need to get this thing up. They got to show that they didn't have a completely crappy month. So they're just marking their books to close the month. Are they doing it nefarious? No, but they're just basically clearing out all their shorts or not clearing out all the shorts, but they're clearing off all their hedges to get the market to get up just so they could get them on. And say we close the market at whatever high it was. So let's say the market was down. Let's just say for argument's sake, I don't know what it was. Off the top, I have it written down and have it here. Let's say the market was down hypothetically 10%, let's just say. And then on Friday, they ripped it 4% and they closed the market at 6%, down 6% on the month. Okay, everything is fine. We can keep moving. We could keep moving forward. If they were to show that that they closed the market 10, 11% down, there would be a statement blow. Okay. So that's really one of the reasons why we popped the way we did. Because to be honest with you, nothing changed from before. Yeah, exactly, for the show. And they do this all the time. And the market forces, they do this all the time. Okay. Because really nothing changed from, let's say, 1 o'clock when we were falling out of bed until 4 o'clock when we exploded. Yeah. Everybody got a good laugh and a good chuckle on the press conference. We really started ripping after that. Nothing changed. Zero. Just out of curiosity, does anyone know why we gapped up today? Anyone want to take a guess why we gapped up today? And it's not because of short covering, and it's not because of oversold conditions. Anyone want to take a guess why we gapped up today? And then we'll get into a little bit of an analysis. Let's have some more questions on volatility. Why were futures up? This happens every single month. So for those of you that are trading the indices or trading stocks, this is something you can carry forward. I'm hoping that all this information you can start carrying forward a little bit, but we do this every single month. Tell me what we do every single month. We get new fund flows every single month. The first day of the month, there are always new fund flows. You get 401k funds, pension funds, mutual. There's always new fund flows coming in every beginning of the month. So the reason why the market was up this morning was because all these new fund flows are coming in the morning. Okay. So when you have more buys than sells, what's going to happen? Market's going to go up. Okay. Here's where we're having issues. Okay. And for those of you that are astute participants, you're going to notice this. Okay. Actually, I'm not even going to say it. I'm going to ask the question. What have you noticed over the past couple of days that has been happening almost every single day? What kind of gap are we having and what's happening? What's happening? It's almost consistently every single day for the past week and a half. Give you a chance. I don't want to be rude all the way. We're going from green to red, right? They're selling every single rip, right? You're all getting it. You're all great. I'm so happy. You're all great. You're all fine. You're all seeing it. They're selling every single rip, let me ask you a question. Okay. We're going to leave technical out. We're leaving all that shit out of the way. Okay. We're just talking about normal, logical. Okay. If you have a market, any market, where every time the market goes up and it goes green and they sell it off, would you say that is a healthy market or a non-healthy market? Forget about if you're long, if you're a bear, a bull, it doesn't make a difference. If you see a market that every single day it tries to move up and every day it gets sold without fail, is that considered a healthy market or is that considered a non-healthy market? What would you say to that? Perfect. Exactly. So what we're going through right now is not healthy. So it's risk off. However, I'm going to ask you a very simple question. We're not going to be talking about a trader hat. We're going to be talking about our logical hat. Okay. Do you know why people get hurt in the market? And by the way, this happens to the funds also. Don't think that it doesn't happen to them. Okay. Do you know why our volatility is exploding the way it is and why the market is ripping around the way it is? Want to know the real reason? Because emotion takes over and people are buying tops. They're selling at the bottom. They're getting blown out each way. When markets are going up, they're taking off all their hedges. They want to get out of them as fast as humanly possible. When the markets, they don't want to be in them. They want to be max long only. When the market is dropping, they want to put their hedges on. They can't wait to get them on so they can protect. They're not making money on their hedges. So as soon as the market gets off, they're ripping them off so that they can just be max long, and it's not working. And they're buying tops and they're selling bottoms. And they're doing this over and over again. That's why you're getting this like wacky price action. Okay. Let alone the news. This is not really what I would say. If you are a guy like Cobb is more of a swing trader. I know him. So he's more of a guy who holds for a few days. Okay. This is a nightmare for him he cannot do anything with this because he's going to get killed. Because even though he can catch maybe a move from morning to night and possibly hold it, if he doesn't get out at the 9:30 bell, there's a very good chance not only is he going to give back everything he made, he's going to give it back. And then, so for a guy who's holding for multiple days, this is a disaster. This is what I would call extremely bad volatility. He doesn't want to see this. He wants to see this smooth, just moving up, chill, pull back a little bit, nice, nothing crazy. This is what he wants to see. Okay. That's what he wants to see. He doesn't want to see this up, down, up, down, up, down. That's not what he wants to see. As a trader, this doesn't matter to you. You want to see up, down, up, down. That's what you want. You want that volatility. This is how you're going to make money. For him, sorry, cop. For him, this is a disaster because this means that he's basically got to be sitting in cash because what's he going to do? Not picking on you. You know that. You know I love you. You know I'm not picking on you. Okay. So this is what would be considered bad volatility. As an intraday trader, this is like a godsend. You understand the difference? You're starting to understand the difference a little bit. I want this to be something you can actually carry forward. And however you do things, I want you to be able to take a second just to think. Okay. No, not necessarily. No, not at all. It's more of bad volatility would be Nasdaq open, 930 to 935. That's atrocious volatility. Wide ranging bars is markets are forgiving. It's good volatility. It's very good volatility. Volatility for tape bombs. So does anybody here look at oil during the day or trade oil? Anybody? Oil, natural gas, things like that? Serious question. So I'm going to pull this up a second. I want to show you something. We're still looking because I don't normally do this. Okay. This is oil. Okay. This is oil tonight. Okay. Everybody see this? Everybody see this? Let me see if I can draw something up here. Oh, damn it. I do not like thinkers. I hate this platform. Everybody see this? Oh, seriously? Okay. I'm hoping it's coming through. Okay. This is a tape bomb. This is pure news. Let me get rid of this because this is not, if were trading this and this is basically a tape. In 10 minutes, the market moved 128 ticks, $1.28 in 10 minutes. This would be bad volatility. That's what this was. Okay. This is natural gas. Natural gas was moving up nicely all day long. This is good volatility. Nice range expansion. It's moving. No, nothing crazy. This is heating oil. Okay. See tape bomb. See that? See that big move down? Bad volatility. This is gasoline. Okay. Same concept. You see this? Bad volatility. There's a very big difference. Okay. Okay. Let's do a quick rundown. Any questions before we do a quick rundown on markets? And then we're going to wrap it up because I don't want to take up too much of your time. I don't want to bore you. Any questions before we move forward? I'm going to let Jim ask this question while he's typing it. Embrace volatility. Volatility is your friend. Okay. I think there's a lot of good. Is that true what he's saying? Is there a lot of confusion between volatility and speed of market? Are you guys confused on that? Because that's fine. Let me clarify it. I don't want you to be confused. Volatility and speed are two different things. Okay. You know what? Let's do this. Let's do this. Let's do this. Yeah, you know what? Let's do that. Oops. Oh, come on. I am not very good at this stuff. Here we go. Let's do the definition. Pretend that we're what's it called? Volatility. Okay. Should we do the Copilot? Let's do the Investopedia. Okay. Investopedia is usually good stuff. Okay. Volatility, meaning in finance and how it works with stocks. Okay. If I read this to you in statistical measure, you should all throw rocks at me because you'll be like, what the hell is this guy off? Let's go back to a different way. Okay. Volatility is a way to just measure how far a stock or any instrument, doesn't be a stock, anything is moving. What is the distance? Okay. So when it goes from $80 to $82, that's a $2 range. Okay. If the instrument is going on an average day, $2, then you know its normal volatility or its normal range from high to low is about $2. Is everybody clear? Let me get rid of this. This is going to just confuse you. Is everybody clear on that? That definition. Forget about it. That's going to just confuse you. Okay. 80 to 82, the thing moves $2 a day. That's from high to low. That's its range. Okay. That is its normal volatility, meaning its movement. Is everybody clear on this? Okay, good. Okay. Speed of market is very different. Speed of market just means that. How fast is the market moving? You could have a market, let's say, I don't know, let's say bonds that have a lot of orders slamming. And you see, you guys look at, what do you call that thing? I don't use it. That's why. The tape. What do you call it? The time and sales. Thank you. You guys watch time and sales ever? Anyone not watch time and sales? I don't personally. Okay. So when you're watching time and sales, never. Okay, good. Fine. That's fine. When you're looking at time and sales, the orders that are coming through, it's fine. It's a little bit. If you ever watch it and you just see the prints coming through, that's just the speed. How fast are they? How fast is it coming? You could have a market that trades in a 25 cents range, 25-cent range all day long and be crazy fast, but it's really not going volatility wise, not really moving anywhere because it's only going 25 cents. You understand the difference? You understand? You can have that. You can have a market that is moving in a $4 range, but moving slowly, but it has a lot of volatility because it's moving range wise from in $4. It could be going crazy fast, hundreds of thousands of shares shooting off or hundreds of contracts shooting off, and the thing doesn't go anywhere. That's the speed. Speed is not a measure of anything. It's just how fast is orders. It's an urgency, whatever, but it's just speed. It's not really volatility. Volatility by definition means movement, range. How far is the travel distance? Is everybody clear on this? I want to make sure you're clear. Those two people are clear? Okay, good. It's important. You need to know that that's this distinction. Okay, good. Good. Okay. Now, don't confuse speed with volatility because they're not the same thing. Okay. When you look at Nasdaq in the morning, by the way, I do not encourage anyone to trade it. Just telling you straight. I'm going to tell you a secret, which you probably already know, but I have a broker friends and he's told me plain and simple. There's one instrument that's blown up more accounts. And I don't know about these funded accounts. I'm talking about live accounts in a real brokerage. The Nasdaq has put more people out of business than anything else. So my advice to you is do not trade it. Just my personal opinion. You do whatever you want. I'm just telling you that more people have lost money and thousands of dollars, real dollars, trading the Nasdaq than any other instrument. Just be aware of that. Okay. Yeah, it's worse than natural gas. Much worse. Seriously. Okay. Okay. So we're clear on what's it called? So we're going to do a quick rundown. It's dangerous. If you have a real problem, it's good that you bring this up, Mike. If you have a real problem, it's really dangerous. It's really dangerous because you could really get addicted to it, like very quickly, really quickly. I'm not a dome trader. I've never been a dome trader. I discourage it personally. I think that the dome is crack for the middle class. That's really what I think it is. They just basically get addicted to it. I think it's just crack personally. And if you're trading the Nasdaq on that thing, it's crack laced with, I don't know, with fentanyl. It's nuts. It's just nuts. I'm just curious. I'm actually not making fun. Or do you feel better at the end of the day that you don't feel that your heart is racing, that your hands are sweaty, that you're able to think clearly now that you're not looking at this crap anymore? Good. I'll tell you, my guys, we don't even look at the indices. Just telling you facts. I don't let them. They don't even look at it. Not at all. They don't know where they are. If you were to ask them, where are the indices? They have no clue. That's just that's not where they live. And they're happier for it. And their success is because they got away and they're just doing what they're doing, at least what we're doing. And they're perfectly fine. They're perfectly happy. No problems. You can't really, it's so difficult because it's so thin that it's very hard to trade that thing with discipline. You could lose your cool with it and become very impulsive with it very quickly, very quickly. And by the way, it's not bad. The problem you have with it more than anything else is that you become very price sensitive. That's the biggest problem. Because let's say, for example, let's just say, I'll make up a number. Let's say you're a 5-lot trader, right? And I'm talking about regular contracts, a 5-lot of regular contracts, okay? So you know that it goes every 10 handles is $200, right? Per 1 lot. For those of you that have traded it, right? Does that make sense? Every 10 handles in the NQ is $200 on a 1 lot. You guys were trading this. I hope you know how much this thing was. Anyone else besides B Money trading NQ? No one else traded it?
Well, you took a lot when you worrying about putting another motherfucker on.
So it's basically $200, right? You don't trade NQ. Fine. Mike,
Right.
what's that?
Sit down and eat my food and you relax and chill out. I'm tired. I've been ripping and running all day. Oh, get what you want.
So fine, you don't trade it, but it basically moves $200, right? 10 handles, $20 a point, $200, right? Okay. If you're a 5-lot trader, okay, NQ to move 10 handles, that means 10 points. Would you say that's a blink? You blink your eyes, it's moved 10 points? Honestly. Serious question. 15 a blink. Okay. If you were to sneeze, would you say that it moves basically 25 to 50 handles, right? In either direction? Easy. Okay. Let me ask you a question. If you're a 5-lot trader, yeah, 100%. If you're a 5-lot trader and you know that 5 lots for 10 handles, 200 times 5 is $1,000, right? If it moves 25 handles, 25 points, that's $2,500, right? If it moves 50 handles, that's $5,000. And you know it can do it in a sneeze, right? We're all in agreement on this, okay? If you're a 5-lot trader, how do you really think that you can handle when it goes up 50, you're up $5,000, it pulls back 45, now you're only up 500. You were just up $5,000, now you're only up 500. Then it's going up, then it goes up 15, then it pulls back 17, then it goes up 30. And it's doing all of this in a 10-minute block of time. How? I'm just curious. Do you really think your nerves could handle that? I'm doing this a long time. I'm telling you, I can't handle it. And I trade big position sizes. I could never handle it because it's not possible. And what Mike says, if you got caught on the wrong side of it by accident, and you're a 5-lot trader, and the thing moves 100, 150 points against you, you're done. Just do the math. You're done. Why people are attracted to it, I don't understand. I'll be honest with you. I don't really understand it. No. I guess people are, that's where the addiction comes in. That's where it becomes very dangerous. Okay. But I don't want to get too off topic because I want to keep you guys interested. Okay. So far you're cool on volatility. I figure maybe we'll wrap up with a quick overview of what's going on in the market, and then we'll open up for questions, and then we'll say goodnight. Is that cool? You all good with that? I know it's hard to understand some of this volatility stuff. I get it. Trust me, I get it. I'm doing this a long time, so it's definitely a little bit hard. For me, it's second nature. It's just very easy. I'm really trying to put you in positions where you could think outside of the box and understand why certain things are happening and what to expect and how to protect yourself and who the players are. And not so much who the players are, but why things are moving the way that they are. And tape bombs, you really have to be careful of tape bombs. I'm telling you right now, going into tomorrow, right now, facts. Okay. Forget about data. The hell with data for right now. Okay. Data is not going to rule the day. Right now, you're going to bed tonight, wherever you are in the world. Okay. You're going to bed tonight. Okay. You're going to wake up tomorrow morning. Going to sleep tonight. The U.S. has shut off aid to Ukraine. That means some kind of news is going to hit the tape tomorrow, right? It's not possible that there won't be any news. Something is going to happen tomorrow, right? You need to just be aware of it. Okay. If you're aware of it, you can plan for it, even if it doesn't happen. Okay. When you're getting into how will the market react to it, I think there's one of two things that could happen. It's a good question. I think the market is looking to get to the 200-day. It's just my opinion. I think it wants to get there. It's basically begging to get there. So I think with the combination of Ukraine aid being turned off Mexico and Canada tariffs going into effect tomorrow. I think this isn't over yet. I'll be honest with you. I don't think this is over. I think we're going there. If you look at it here, the NDX is basically, it's 1 day away from it's basically 300 handles away from it. That's nothing. We just talked about how it can move so quickly. So it's nothing. And tech is 32% of the S&P. So the S&P probably gets there within the next day or two. 58.49, 57.07, catch market, let's say 75 handles. Easy. It's easy to do it, right? It's very easy to do it. Okay. Very easy. So just be aware of it. Okay. If you're uncomfortable, I want to make sure I'm very clear with you on this. Okay. If you're uncomfortable with what's going on, take your hands off the keyboard and sit on it. Do nothing. You do not win awards for getting your asses kicked in the market and saying, oh, by the way, I go up an account today, or, oh, by the way, man, the market ripped me to shreds. You don't win awards from it. Okay. You don't. And why would you want to put yourself through it? I always have to think, when in doubt, state. You don't win an award. You're not missing anything. If it's not the way that you trade or the way that you're learning to trade or the way you want to trade or whatever it is, don't be involved. You don't win an award. I see it all the time. Sometimes I go through these rooms and I just see some of the conversations and it's amazing to me. You know, it's like a badge of honor. I got my ass kicked today in the market. Why is that a badge of honor? You're coming here because you want to make money. You're not coming here because you want to get creamed. You want to get your kicks, go someplace else. This is not the place to do it. This is a place where you got to put your big boy pants on. Your competition, besides algorithms, just so you know, your competition are PhDs, some of the smartest people on the planet play in this game. That's who your competition is. They want to take your money. If you don't have an edge, don't give it to them. Stay out of it. Wait for it. Wait for however you trade, wait for that situation. Okay. It's important. You don't win awards for this. I'm going to tell you a fact. Okay. As a trader, you're going to make 80% of your money 20% of the time. I'll repeat it. As a trader, you are going to make 80% of your money 20% of the time. The other 80%, you're trying basically not to get creamed and not to give it back, or not to give back too much of it. I'm just telling you what happens. Okay. I'm doing this a long time, a very long time. I've seen people come and go. I've seen people lose hundreds of thousands of dollars in an hour. I've seen people lose millions in an hour. I've seen fortunes get blown within a few months. Multi-million dollar fortunes. I've seen it all. I've seen people do very well. Okay. So trust me when I tell you, this is not a game for the meek. You really need to come in ready to rock and roll. You need to be ready. And if you're not ready, don't be here. Don't be there. If you're not prepared, don't be there. I'm just telling you facts. Because, like I said, this is not a game for the meek. And if you're wrong, you could get really hurt. And if you're trading your own money, which, you know, if that's what you're doing, if you're really wrong, you really do. I don't want to finish the sentence. I don't want to finish the sentence because you know exactly where I'm going to go with it. Okay. So just be aware of this. Okay. It's very important. So I think it was Phil. Or it was Saeed. I'm not sure. One of the two asked the question of how do you deal with stops and high volatility? So if you're not comfortable with it, you have one of two options. Either you got to size down completely and make your stops very wide, or you got to stay out. That's it. Those are your two options. It's one of the two. There's no middle ground here. It's either you size down and make your stops incredibly wide, or don't be there. And you should not be in the Nasdaq. That I'm telling you right now. I know that all of you are not going to be there, but I'm just telling you that's where you should not. Okay. Let's do a quick rundown of where we are, what to expect, where we're going to go, et cetera, et cetera. Take a little questions, and then I'm going to bid you farewell and good night. Let's start with the S&P. Okay. Ignore this. It's called a McClellan oscillator. It's not really an oscillator. This is a different type of oscillator. It's manipulated. So just ignore it. This is the S&P cash. Okay. These moving averages that I have up here are the 8, 21, 50, and 200 EMAs. The reason why I don't trade moving averages, the reason why I have it up, the real reason, you want to know the real reason? You got to laugh, but that's okay. Equity traders of the prop world use this, and I like to see what they're doing, and I like to follow I like to see where they're going with things. I don't necessarily look at moving averages. It doesn't mean anything to me. To me, they're meaningless. As support and resistance, I look more at slope and rate of change. So they're sloping down. That's what I'm looking for. That's what I'm looking at. Okay. That's really what I do. I think Steve wants me to do a moving average thing at some point. So maybe I'll do it in the next couple of days, but I look at slope and rate of change. That's all I focus on. Okay. In equities, I use 821, 50, 200 EMAs. Again, not because they mean anything to me, but just because that's what the equity world is doing. I want to see what they're doing. Simple as that. Okay. Who here watches CNBC? Anybody watch CNBC or Fox or Bloomberg? Anybody watch that? They watch that stupid stuff during the day? Want to know why I have it on? I have all three on. You want to know? With all muted. You want to know why? Because I want to see what all the idiots are watching. So that's why I have that stupid stuff on. So I could just see what the idiots are watching. No, the red tape on. I have a Bloomberg terminal. I have news feeds. I have everything. I don't need it. I literally have it on so I can see what the idiots are watching. All the dummies, they're all watching this stuff and taking advice from them. I want to see what they're watching. That's simple. To me, it's an indicator. It's a sentiment indicator. I know it's weird, right? Anyway, so we have a situation now where you're getting the S&P basically at this point in time, this January 13th low of 57.73, that's going to be gone. We got close to it today at 58.10. They're going to take this out. Okay. That's for sure. This is basically this is basically done. Okay. So you have to assume that the market probably wants to hit this 200. Okay. That's what you have to assume. You cannot assume a bullish change in trend until these 3 days, not even this 3-day high, this high from February 26th at 6,009. Until you see the S&P above 6,010 in the cash market, you cannot assume that this is going to go down. Trudeau just announced 25% tariffs on U.S. goods will take effect at midnight. Oh, this is going to be, tomorrow's going to see, here's your tape bomb. Here you go. But we knew this was coming, but here's a tape bomb. Something to prepare for. Okay. So you really can't get bullish this thing until we're above 6,010. I'm just telling you, you just really can't. There's really no reason to. What you want to hope for is a build out this way, little consolidation, just build out this way, hold, and then a move back up. But the probability is telling me that we're probably going to this 200. What happens at it? I don't know. Am I going to sit here and tell you what's going to bounce automatically off of it? If there's a fundamental shift because of tariffs, this is not going to hold. Everybody's looking at this. It's not going to hold. And by the way, I want to make sure I'm very clear on this, and I want you to listen to me, and I want you to remember this. Okay. Just because you draw a line or a Fibonacci or a FANG or whatever the hell you draw on your charts, you draw something like this or a box or whatever on your charts, don't you for a second think that the market has to stop there. Because if somebody needs to move something, they're going to do it. They don't care about it. Your lines are irrelevant. They're going to move it. Okay. So don't think because you made a line and all of a sudden you found a way to make it line up and everything lines up. It's perfect. Look at it. And you put the thing, oh, it bounces to the tick and that everything is beautiful. Life is wonderful. Yeah. Okay. That's very nice as a Monday morning quarterback. In reality, if somebody needs to move something, they're going to do it. So just keep that in mind. Okay. So don't think because you have some kind of line or whatever it is, you can just put an order here and let the market slam into you. Okay. Everybody sees this 200. They know where it is. If they want to push if the market wants to be pushed through it, you can put your order over here and then you can say bye-bye as the market goes down. Okay. So be smart about what you're doing. Fair enough. Is that cool? Okay. I'm only saying this because I don't want anyone to get hurt. So that's the S&P. All right. Let's go to a different market for a second. Okay. Let's just go here to the FANG index. This is one of my favorite cash indexes. Most people don't use it. Most people don't even know it exists. This is basically 10 names. It's a NYSE listed index. It's Mag 7 plus 3 more. Okay. Plus Netflix. I don't know if Netflix is in it, but basically it's Apple, Amazon, Google, Meta, ServiceNow, CrowdStrike, NVIDIA, Broadcom. I forgot I lost track of what else. Okay. It's one of my favorite indexes. It's basically an index it's NYFANG. Let's see what's in it. Hold on. Here. Let me show you what's in it. FANG Plus. It's a great index. I think it's one of the best indexes out there. Here. FANG Plus. Come on. NYSE FANG. NYSE, whoops, sorry. NYSE FANG index. Here we go. The NYSE FANG index. This is what's in it. Meta, Apple, Amazon, Netflix, Microsoft, Google, CrowdStrike, NVIDIA, ServiceNow, Broadcom. 10 names. That's it. That's the whole index. Okay. It's basically weighted like the Dow. So you take all the names, divide them by 10, add them up, divide them by 10. That's how you get your index. The reason why I like this index, I think it's a great index, is because if, as we talked about earlier, that Mag 7 and FANG basically control the market, right? We talked about this. Top 10 names are these names. They're all in here. So you don't really need to see a lot about what's going on in the market because you can just look at this index, because this index is basically going to tell you, it's basically going to tell you what's going on in it. You get where I'm going with this? How is it? Capish? Okay. So this index, if you look at it, you'll see that the markets are basically bent. That's not a question of correlates. This is the market. These 10 names are the market. Okay. So this is really collapsing. And you can tell by the FANG names that they're basically, the only reason why, by the way, just you should know, the only reason why, let me just show you, the market is not getting completely annihilated is because of this. Because everybody is hiding here in the mighty Apple. If Apple was down here, it's good night, Irene. We would already be down here already. Because Apple is holding up and people are hiding there, we're not falling out of bed. So Apple's, it's the number one weighted stock in both indexes. It's the most important stock in the world. Okay. So just, even if you don't like their products, it is the most important stock and it is literally holding up the entire market right now. Apple, just by itself. Okay. As you can see, the NDX, obviously it's quite easy. It's quite easy. See, it's about to hit that 200-day. We'll see what happens here. If we open up tomorrow, so you have to ask yourself, let's just go here for a second. Okay. Let's do this. Let's just do this quickly. Okay. If you're an ES trader, you know what? Hold on. If you're an ES trader, okay, what do you think you should be looking for tomorrow? What do you think would be, let's set this up. I don't use this platform, so I apologize. It's not really the platform that I use. If you're an equity trader, what do you think you should be looking for tomorrow? Whoops. I'm sorry. If you're an indice trader, what would be ideally your best? Let's do a daily chart. Okay. Interesting. Anyone else want to take a shot? I'll tell you what I would be looking for, but tell me what you're looking for. If I want to buy this thing, you know what I would be looking for? I don't want to see the market here. I don't want to see the market here. I want the market to open up down here. That's what I want. Why? Because I want to see the market go from red to green. I want to see the market open down here and move its way back up. Buying over here, not interested. I don't know what that means, but I'll take your word for it. If the market opens up over here, it's probably going to come back down. I want to see the market open up down here and buy it for red to green. I would probably be looking to trade somewhere against this low. I would want to see the market come back up, take this low out. I get long, I would put my stop at the low of the day and let's see what happens. Okay. That's what I would be. Okay. Okay. I think that's about it. Open up the, yeah, it would be a gift. It would 100% be a gift. 100% be a gift. 100%. Okay. Beware of your tape bombs. Beware of heightened volatility. Volatility is your friend. It is not your enemy. Volatility is just movement. The more range you get in a market, the more forgiving a market is. Okay. So when you have a market like today, what did the S&P move? Like 150 handles? What did it move? Something like that? What did the S&P move today? Range-wise, high to low. Anyone know? Wow, 175? Look at their bunch there. What's it called? I'll get to them in 1 second. 175. 175 handles. You know what that means? If you make a mistake in a 175 handle move, the market's very forgiving because you can find a way to fix your mistakes. If the market's moving in 25 handles, it's not moving around. That means if you make a mistake, you're screwed. 175, you have a way of fixing things. You get it? You get the difference? I don't say when no one understood, no one gets the difference. Don't be shy. Okay, good. So let's talk about the CNBC stuff for a second. Okay. It never fails. The market will rally. It never, ever fails. You'll see it. You'll see all the reporters, the market's going up. It went from, let's say, red to green, and the market's going up, and all of a sudden the suits are all finely pressed, and the ties are nice, and the makeup's on, and the hair is all beautiful, and everybody's looking all great. Market's going up. Cheerleaders. Oh, that's great. 15 minutes later, the market finds some kind of tape bomb happens. The market takes a dump. And you see these same people, mascara is already dripping down the face. The tie is open. They look like grim death. Oh, that was a terrible sell-off. Oh, this is crazy. Oh, man. It never fails. It never, ever fails. Ever. So that's why I don't pay attention to that stupid stuff. But people who don't know what they're doing, they pay attention to it. The only reason why certain people have a job after the market, they have a show, you know what I'm talking about, is because there's so many people who listen to that stupid stuff. That's why they have a job. That's the only reason why. Anyway, let's stop the share. Let's get to questions. Any questions, comments? You want to yell at me, tell me I'm an idiot? I'm fine with that too. Whatever makes you happy. Hopefully you don't tell me I wasted your time. I'm hoping you didn't. I'm hoping you got some kind of value out of this. The idea is for you to embrace the volatility and not be afraid of it. It's really not there to hurt you. It's really more about understanding the movement that's happening so that you don't necessarily need to capitalize on it. But if you make a mistake, you know that the markets are moving around enough that you can fix a mistake. And that is very valuable. When markets are very forgiving is when things are great. Okay, good. That's really where you want to be. Don't be afraid of volatility. Like I said to you, the best, easiest, comprehensible volatility idea that you can wrap your head around is, and I'm not picking on it, but 930 Nasdaq, volatility, very bad. Fuck. It's not your friend. Market S&P moving 175 handles, that's your friend. You don't have to be really big. You don't have to, you do what you're comfortable with. There's no, like I said to you, you do not win an award for getting your clock clean. You don't. And there's nobody here who will tell you that. Not me, not Steve, not JJ, not Taco, not LC, nobody. Marco, nobody. No one will tell you that there's something cool about it. There is nothing cool about it. Because I'm going to tell you the one thing that you're going to look that happens when you get into this pattern. You will never realize your potential and you become a statistic. If you don't respect what you're doing, you will never make it. I'm just telling it to you, facts. It's not just discipline. It's not just methodology. That's X's and O's. If you don't respect what the market is, you will never get to where you want to be. That I can tell you. You need to treat it with respect. This is a big boy game or a big girl game. You need to understand who your competition is. Your competition takes this very seriously. You cannot come in and willy-nilly just say, I'm going to just wing it. You're not going to survive. And what happens is eventually, if you survive, the ones that make it are the survivors. And eventually something clicks, you find your niche, and then you go. But if you don't survive, you don't make it. You just don't make it. I'm going to say one thing. Hold on, if there's nothing else, I'm going to stop the recording for a minute. I want to talk off screen. Is that cool for one quick second?